Welcome to Talk Tickers. Today, we're breaking down SoFi's Q4 2025 earnings call, and wow, is there a story to tell here? Okay, so here's the setup. SoFi delivered an absolute monster of a quarter. We're talking record revenue and a solid beat on earnings. Should be a home run, right? But the market, it punished the stock, which sold off more than 6%. So what is going on? That's the disconnect we're going to unpack.
You see this all the time. Great news, and the stock tanks. It's enough to drive you crazy. So what did Wall Street see that the glowing headlines might have missed? Okay, let's dive into this.
First things first, before we get into why the stock got hit, we really need to understand just how strong these results were. And I'm not exaggerating here. These numbers weren't just good, they were legitimately record-breaking.
Let's start at the bottom line. Adjusted earnings per share, they came in at 13 cents. Now, the consensus on Wall Street was 12 cents, so that's a nice, clean beat right there showing that profitability is strong.
And it was the same story for revenue. Adjusted net revenue hit over $1 billion, which blew past expectations by a cool $25 million. Another big beat that you'd think would make investors pretty happy.
And just look at the scale of this growth. This wasn't just a beat. This was their first ever billion-dollar quarter. I mean, that's a huge milestone. We're looking at a 37% jump in revenue year over year. And their adjusted EBITDA, it soared an incredible 60%. The growth engine is absolutely firing on all cylinders. So you might be asking, how are they doing it? Well, this is how. The member growth is just staggering. They added over 1 million new members in a single quarter. Total products are up 37%. And maybe the most important number on here, deposits jumped by $4.6 billion. That is the famous flywheel effect in action. More members join, use more products, and bring in more low-cost cash for SoFi to lend.
So the numbers are fantastic. That much is crystal clear. To understand the sell-off, we have to look past the spreadsheet and really listen to the story management was telling on the earnings call. And the tone from the top was anything but worried. CEO Anthony Noto was basically taking a victory lap, calling 2025 a tremendous year on all fronts and saying he could not be more excited. This was not a management team trying to lower expectations. They were projecting total confidence. Now, here's a really crucial part of their strategy. They're making a big pivot to something they call the loan platform business, or LPB. Instead of holding all the loans they make on their own books, SoFi is basically acting as a matchmaker, creating loans for other companies. This way, they get paid a nice fee, and they don't have to take on all the balance sheet risk. It's a much more capital-light business model. So the main messages from the call were pretty simple. 1, go hard on this capital-light LPB model. 2, they know they're losing a big tech client next year, and they have a plan for it. 3, surprisingly, they're getting back into crypto because partners are asking for it. And 4, that LPB pipeline is already growing. They've signed a new partner with more on the way. Okay, now let's talk about the guidance, because this is where the market starts to read between the lines and get a little bit nervous. On the surface, the guidance looks really strong. For the full year 2026, they're calling for about $4.65 billion in revenue. That's about 30% growth, and projecting around 60 cents in adjusted EPS. These are some pretty confident numbers to put out there. But, and there's always a but, isn't there? This is where the story gets tricky. The analysts on the call started poking holes. They grilled management on things like deposit beta, a fancy term for asking what happens to their profits if interest rates fall. They questioned if the profitability could really last, and they seemed pretty skeptical about how reliable that new LPB business is and how SoFi is going to replace the revenue from that big client they're losing. These questions tell you exactly what the market is worried about. And then you see this, and it all starts to click. This is probably the biggest piece of the puzzle. Just look at the stock's run-up. SoFi was up almost 135% in the year leading into this report. For comparison, the S&P 500 was up about 18%. When a stock has a run like that, expectations are just astronomical. It's the classic buy the rumor, sell the news situation, where all the good news was already more than baked into the price. So, let's put it all together. You have a fantastic quarter and a super bullish management team. But you also have some underlying worries and a stock that was priced for perfection. So here's our take on it. We're initiating with a market perform rating. Let me be clear, the company is executing beautifully.
But the valuation after that massive run already has a ton of future optimism priced in. This isn't a knock on SoFi at all. It's just a realistic look at where the stock is trading right now.
So how might a professional trade this? Well, here's a plausible idea you might hear at a hedge fund. First, you see that massive 135% run-up. Second, you see the sell the news reaction. Third, and this is the key, you notice that after earnings, something called implied volatility gets crushed. All that means is that options get a whole lot cheaper because the big uncertainty of the earnings report is over. So the pitch could be to buy some long-dated puts as a hedge, a way to protect against the stock pulling back to a more normal level.
And the crucial point is, and we always have to say this is not financial advice.